G'day. Today we're talking about the balance sheet. As I've discussed in previous episodes, the balance sheet records all the things that you own and all the things that you owe. Now with a balance sheet, as I've touched on earlier, we run into things called assets, liabilities and a thing called equity. Now in the assets section, you will recall that we talked about current assets and non-current assets. Current assets are things that we can convert to cash quite easily within 12 months, and that will generally include things like your cash at bank, which is already cash. It'll include your debtors, which is what people owe you. It'll include your stock, and hopefully you're turning your stock over at least once a year. So main things that are able to be realised within 12 months. Then we move into the non-current assets section, which talks about the assets that you own that have a longer lifespan in your business. These can be properties, these can be motor vehicles, it can be plant and equipment. Say you're in a manufacturing business and you've got your production line. That will be in non-current assets because that has use over a number of years. It's not just a single year use type of asset. So we'll have the non-current assets along with the current assets, and they will add up to your total assets. Now, there's a couple of other things that you might see in your balance sheet as well, and these are things called intangible assets. Now, when we talk about intangible assets, tangible assets are like this mouse. You can touch it, you can feel it, you can do things with it. Intangible assets are things like goodwill. So when you buy a business, oftentimes there'll be a goodwill component. That goodwill component is what we call an intangible asset because you can't actually touch it. You can't pick it up and move it over here and say, there's my goodwill. It can be things called intellectual property, which is a concept or a business idea that you may have developed or you may have bought from someone else. So these intangible assets will be in there, and you'll often see in the balance sheet of companies, you'll see a thing called formation expenses, which we haven't been able to expense until recently, but what that does is it records the costs of actually establishing your structure. And over the last few years, they've brought in legislation that says we can write that off over 5 years, so we what's called amortise that. So within the assets, we'll have tangible assets, which is cash, debtors, stock, property, plant and equipment, and we can also have, as I said, intangible assets. Now, when we talk about the assets, there will generally be liabilities associated with running a business. These liabilities can include bank overdrafts, it can include bank loans, it can include money that's owing to you from the business. So we've got to look at those as well. So similarly with liabilities, we talk about current liabilities and we talk about non-current liabilities. So current liabilities are those liabilities that we will have to pay within the next 12 months. Non-current liabilities are those that we will have to pay over a period longer than that, and that will generally be your bank loans. So then we take your current assets, which as I said could be bank overdraft, it could be your trade creditors. So the people that you buy that you buy things off and you owe money, we generally call them creditors. So they've given us credit, given credit to us, so we call them creditors. So that's a liability of the business. The other creditors that you can have in the business can be, or people that you owe money to, can be your staff, whereby you withhold money from their wages every week, and we've got to pay that to the tax office at either monthly, quarterly or annually. So there's a liability there for the wages that you've withheld, the money that you've withheld from staff wages. There can also be liability to the tax office for the tax of the entity, particularly where you're trading as a company or as a sole trader. So we'll have liabilities to various people. We'll also have liabilities to the bank, which can be your term loans, and that can also be hire purchase loans. It can be chattel mortgages. You generally won't, however, see lease liabilities listed on a balance sheet because they're what's called off-balance sheet items, and that's why a number of businesses like to have leases in place because it doesn't muck up their balance sheet. So we've got all those things, and we take all the assets and we take from all the assets the liabilities, and we end up with what's called a net equity position. So your net asset position, net equity position. That's what the business theoretically, if it was sold today, would be worth. And when I say theoretically, it's very deliberate because when you actually go to sell a business, what we do is everything in the balance sheet is recorded at the time that you bought it. So I bought this mouse 3 years ago. It might have cost, I don't know, $50, $100. The value of that mouse is in the balance sheet at $50 less the depreciation that we've charged against that, and that will be in there at, let's say, $10. Now, if I was to actually sell this mouse, I might get less than $10 for it, or I might get more than $10 for it. So you must remember when we're looking at a balance sheet that it's all on what's called historical costs or historical values. And this is particularly important when you look at property. Generally, when you buy a property, it will go up in value, but we've got customers who've bought property years ago. I think one of them paid $90,000 for a property. It's in their balance sheet at $90,000. That property is currently worth about $1.5 million. So even though the balance sheet records what we've got and what we own and what we owe, it's all at historical costs, and it might not actually reflect the true value of the asset that's recorded therein. So you need to be aware of that, and you need to have current valuations done, particularly when you're buying or selling a business. You need to know what things are worth. And the final section of the balance sheet, as we've touched on earlier, is the equity section. Now, the equity section generally records the net balance position of the business, and that will say if you're in positive equity, which is a great thing, which means you've been making profits. Positive equity means that that is some reflection of the value, but as I've just said with regard to valuations, it's all on historical basis. The banks generally like to see positive net equity in a business. So, and in the equity section, you'll find things like issued capital if you're a company, settled sums or settlor amount or settlement amount or what have you if you're a trust. It can include the partner's funds, so the partner's equity in the partnership, or your own equity if you're a sole trader that you've got in your business. So, and you'll find that the value of that equity equals the value of the assets less the value of the liabilities. So our net assets should always equal our equity, and if it doesn't, we've got a big problem. The other thing that will be in a balance sheet might be provisions, but we'll talk about them in the next episode. Cheers.